that we find ourselves in, I believe we've delivered a quarter of consistent broad-based performance. Domestic consumer growth is sustained, and we've continued to expand margins even as we've made significant investments in this quarter. Having said that, volume growth is a little lower than what I would have liked, but we know what's led to it. It's limited to few specific reasons, and actions are underway where required. I will talk about some of these a little later. I'd like to start with some comments in the market context, which many of you have questions on. Now, despite the inflationary pressures in the economy, FMCG markets have continued to show some resilience in terms of overall growth relative to other sectors in the economy. Having said that, as indicated in our previous interaction, we have seen some moderation in growth rates in some discretionary categories. This is clearly reflected in market growth rates in the second half of the year, which are slower than the first half. Notwithstanding this, we continue to believe that the growth outlook over the medium to long term for FMCG looks positive, and we will see secular trends on premiumization of consumers wanting to upgrade and adopt niche and aspirational categories. From a channel perspective, the positive in the quarter has been the fact that the CSD channel has started to show signs of recovery. On the flip side, however, a key development is that modern trade as a channel has slowed down. In December quarter, the number of store closures is outnumbered new store openings. Again, while this is something for us to be conscious of, we have absolutely no doubt that this is a transient phase and that modern trade is poised to become a larger contributor to our business over time. And therefore, while slow modern trade growth has impacted this quarter adversely, we are not losing sight of the larger opportunity that modern trade offers. Competitive intensity is sustained at high levels. From a media perspective in the quarter, we've seen it hold or step up in categories such as laundry and across personal care categories like skin, hair and oral. You have heard me say before that we will not compromise on our competitiveness, and therefore we have continued to invest behind our brands, and this is reflected in our A&P numbers, which have gone up this quarter. In particular, we have stepped up our investments behind the F&B segment in the quarter, well ahead of the gross margin expansion that we've seen in that segment. We remain strongly committed to ensuring that we are competitive in the marketplace. Let me now move on specifically to talk about our volume of growth in this quarter. Our volume growth has been lower than what we've reported over the last several quarters. The UPG in this quarter was 5%, and there are fundamentally three reasons that have caused a drag this quarter. The first is the pricing transition on Fair and Lovely sachets from rupees 7 to rupees 8. It continues to impact our numbers in the near term. We have taken a hit on volume growth in this quarter, but the fact is that our competitive position in the category and the segment remains strong post its relaunch, and this reassures me that our consumers are with us and the launch has been well received. Having said this, I still expect that the transition will take a little longer before it stabilizes. The second area which has pulled down volume growth in the quarter has been the very high base effect of Dove sachets. The fact is that while volume has been impacted, we have continued to grow value strongly. You will recall that in the last year, we had launched and had a huge volume of Dove 1 rupee sachets given the competitive context that was prevailing then. As the year went by, we had taken up pricing of these sachets to 1 rupee 50 paise and adjusted fill levels across the totality of the hair portfolio during the year. This imbalance between volume and value I expect will play out for a couple of quarters more. On the other hand, I am pleased that the momentum on bottles has been sustained at high levels. And therefore on Dove, I am not worried because the brand is strong, it's doing well, and it's growing in equity. The third area which has been a drag on our growth this quarter is the brand Wheel. And while we continue to grow strongly in laundry, driving category upgradation, we've had a relatively soft quarter on Wheel. We have taken the corrective action, we are already seeing the brand respond to these fresh inputs. Once again, I'm not concerned about the health of wheel, considering that it has been performing consistently and also considering that it has already responded to the actions that we've taken, and we see the results in the marketplace. In summary, as I look at the totality of our business, on balance, I'd say that the state of the business is healthy. Actions as required have been taken to ensure that we continue to make progress on strengthening our leadership position in the market. I now want to come to the last part of what Sridhar talked about, and this relates to the change in royalty rates. You're well aware that over the last couple of years, we have been receiving a range of services from Unilever, which has allowed us to increase the level of innovation, build scale, and in segments of the future, and benefit from a globally organized procurement organization. All of this have helped us deliver a step up in our performance and strengthen our leadership position. You have heard Sridhar talk about the new arrangement that's been approved by the board this morning. I don't want to get into the details, but I only want to state that the decision was taken after a thorough due diligence to establish that the new arrangements reflect a fair payment for the benefits that HUL is receiving and will continue to receive in the future. I believe that this is right for the India business and will enable us to have access to the larger capabilities that are being built by Unilever with a particular emphasis on B&E markets. And given the context of the huge opportunity in India, as well as the increasing competitive intensity, particularly from global players, Unilever is committed to ensuring that the support in terms of new products, innovations, technologies, and services is commensurate with the needs of the India business, and to help HUL win in the marketplace and generate significant value for all shareholders of this business. The message that I therefore leave you with is that this arrangement will be beneficial to this business. Let me end by saying that with a 7% UVG, 16% USG, and 100 basis points improvement in EBIT margin expansion in the first 9 months of this year, I believe our strategy is well on track and delivering. You have heard me articulate our strategy time and time again, and I will do so once again and reiterate that we remain focused and strongly committed to delivering growth which is consistent, competitive, profitable, and responsible. That's all I have to say, and I'm going to hand you back to Dinesh.
Thanks, Nitin. Thanks, Sridhar. With this, we'll now move on to the question and answer session. May I remind you that this call is only for institutional investors and analysts, and therefore if any of you, anyone else on this call has a question, you might like to get in touch with us at Investor Relations. What I'd like to do now is to hand you over to Saurabh, who will really manage the next section of questions for us. Saurabh, over to you.
Thank you so much, sir. With this, we are going to start with the Q&A interactive session. So I would request all the attendees and the participants, if you wish to ask any question, please press 0 and 1 on your telephone keypad and wait for your name to be announced. I request all the attendees and the participants, if you wish to ask any question, please press 0 and 1 on your telephone keypad and wait for your name to be announced. And here comes the first question from Mr. Avnish Roy from Edelweiss Capital. Mr. Roy, you can go ahead and ask your question. Your line has been unmuted.
So my first question is on the soaps and detergent business. We have seen gross margin expansion, but ad spend has been ahead of that, due to which EBITDA margins have, the margins have contracted. Wheel has seen some issues. So wanted to understand these ad spend, very high ad spend. Is it because of expected gross margin expansion further? Is it because of issue in the wheel? Is it because of the new product innovation in Lifebuoy? If you could give clarity on what really is happening in wheel.
So I think you are absolutely right in your first observation that gross margins have expanded in that segment, and A&P levels have gone up even faster, as a result of which segmental margins have come off. We have stated time and time again that we should resist the temptation to analyze quarterly performance in terms of how these movements are and draw conclusions beyond what are necessitated. You would have noticed that this segment has shown strong expansion in margins over the last many quarters, over the last several quarters. Into this quarter, A&P levels were stepped up based on what we found in the marketplace and our policy of making sure that we remain competitive in terms of our investments in the marketplace and some of the innovations that we've had. But primarily, the guiding factor this quarter was to make sure that on principles and criteria which we have in terms of market, etc., we stepped up reflecting the competitive intensity which had gone up in this segment.
If we go further, is it that whenever we see the gross margins expand and then we see the local players come back, and wheel also we are seeing some issues. So on the lower end, are you seeing marked increase in the lower players' competitive intensity?
So firstly, I would just make a comment on wheel, which you said. I think I don't want to overstate it. It was an issue in this quarter, but like I mentioned in my comments, it is a brand which responds quickly. The actions have been taken, and we are already beginning to see it responding to the interventions which have been made. As a general point, what you make cannot be denied. As commodity costs soften, etc., there is a tendency for local players to start coming in. At this stage, I would not want to say that we are seeing extreme pressure or excessive re-entry of local players. But as a business, we need to be geared to address all such situations, whether it is in terms of players at the top end or bottom end, organized or unorganized players.
One follow-up on that. Any color you can give on wheel, what exactly we have done, and you said some recovery has already happened. So is it in terms of pricing, innovation, branding, some color on that?
Relatively, so couple of interventions. We manage wheel very carefully, looking at competitiveness on a state-by-state and geography-by-geography basis, because the nature of competition often varies. There were a couple of geographies where we made product enhancements and improvements, and there have been a couple of geographies where we have ensured that marketplace competitiveness has stepped up, and in general, advertising intensity has also been increased. So it's been a holistic response as appropriate to the geographies. Like I said, a couple of geographies where we made product enhancements as was required there, a couple others where there was marketplace competitiveness in the form of strong trade activity, and in general, a step up in advertising intensity across the board.
My second question is on the tea business. You said this has been one of the strongest quarter. Also what we see is tea raw material prices are shooting through the roof, and so again, is it your performance, is it again linked up because of the inflationary conditions? We see that the stronger players and the larger players gain when the inflationary condition is there. And could you give us some color on tea bags? You spoke on that. So what's our share in the tea bags, and how do you plan to pick it up further, and some insights on where do you see tea bags as a proportion of tea business 3-4 years down the line?
So first comment is, I think our performance on tea has little to do with the inflationary effects that you talk about. Those inflationary effects are there. The impact of those are likely to be experienced into the future. You're aware that tea is bought into 2 seasons, and we will see this effect as we move forward. So performance in the December quarter has less to do with the inflationary pressures and the impact on local players. So that isn't the reason. As far as tea bags are concerned, no, absolutely zero doubt in my mind that will determine how the categories will move into the future. At this moment, it's a very small and an insignificant contributor to the overall. It's growing very well. The market needs to be developed, but I won't think that this will be the most material part over the next 2-3 years. We will keep growing it.